Some of the richest Americans pay little to no money in taxes. We've all heard of President Donald Trump paying $0 in taxes, even though he's one of the richest people in the world. And Warren Buffett, who's one of the most successful investors of all time, talks about how he pays a lower tax rate than his secretary. And even if you move beyond the famous people, what you'll see is that rich people in general pay a lower tax rate than regular people. And you want to know the craziest part? This is 100% legal. How do I know? Well, two reasons. For one, if it was not legal, all of these people would be in jail. And the second way that I know is because I've spent a lot of time studying the federal income tax code. And what I can tell you as an attorney, who is not your attorney, is that while the federal income tax code is over 2,000 pages long in this super small font, it really only tells you three things. Number one, it tells you how to categorize your gross income. Second, it tells you what deductions you can take from your gross income, which brings you to your taxable income. And then it tells you what is the tax rate on your taxable income. That's all you get from this 2,000 pages. And then once you understand that, either you're going to have a big tax bill or a small tax bill. See, what rich people are always trying to figure out is, for one, how can I have little to no taxable income? And second, if I do have any taxable income, how can I have the lowest tax rate possible on this taxable income? There are four main ways that rich people do this. These are things that you can start doing right now too, but I do have to advise you that before you make any changes to your financial situation or your taxes, make sure you talk to a professional, an attorney, an accountant, somebody that can make sure that you're doing it right, because you don't want to run into issues or red flags with the IRS, because that could end you up in a lot of trouble. The first thing that rich people do is to change the category of income that they get, because not all income is taxed the same. Now, everything that I discussed in this video is going to build on top of one another, so if you're serious about trying to see how you can lower your tax bill, make sure you watch this video until the end. If you made $100,000 and you went to an accountant and you asked them, what is the tax rate going to be on $100,000 worth of income? The first question that they're going to ask you is, how did you make this money? Because if you made this $100,000 from your job, you're going to have one tax rate. If you made this $100,000 from your stock market investments, it's going to have a completely different tax bill. And if you made this $100,000 from your real estate investments, it's going to have a different tax bill. If you go to work every single day and you get paid a paycheck as a W-2 employee, this is called ordinary, otherwise known as earned income. If you sold a stock and you made a $100,000 profit and you own the stock for longer than a year, this is called portfolio income, and you pay long-term capital gains. If you made $100,000 in cash flow from your real estate investments, this is called passive income in the eyes of the IRS. Do you want to know which of these three different types of income has the highest tax rates, meaning the highest tax brackets, and the lowest deductions? This one right here, your ordinary income. The money you make from your job. The money you make from what you do comes with the highest tax rates and the lowest tax deductions. The money you make from what you own comes with lower tax rates, and it also comes with higher tax deductions. So the first thing that every wealthy person tries to do, which is something that anybody can do, is they work to recategorize their income. They don't just work for this ordinary income, they invest their money into assets. That way they can earn this type of income. Portfolio income is when you own an investment and you sell it for a profit. This is like your stock market investment income, assuming you own your investments for longer than a year. And your passive income is things like rental checks with real estate properties. This is a different type of investment income, and it comes with its own set of tax deductions. So wealthy people are working to move their income from here to here because this comes with bigger tax breaks, not to mention the fact that when you own an asset, it also requires less time than going to work every single day. So if we come back to this tax chart, what we just talked about is changing your tax rate, because now when you recategorize your income, you have the ability to pay a lower tax rate legally. The second thing that wealthy people do is they lower their taxable income. So the question here is, how do you lower your taxable income? Because you're not taxed on your gross income, you're taxed on your taxable income. This is the gross income minus all of your deductions. This is what your taxable income is, and this is where it pays to have a good accountant on your side, because a good accountant's job is to help you find the most amount of deductions and write-offs possible. That way you have the lowest taxable income possible, because when you have the lowest taxable income, that means you're going to have a lower tax rate as well. Now, for the majority of people who work a job, if you were a W-2 employee, the way that it works for you is like this. You make money from your job, then you might get the standard deduction, which is what the IRS offers to everybody. And then after the standard deduction, you pay your taxes. And then this is the money that you have left over to go out and spend. This is the money that you can use to buy a car, to buy your home, to go out on vacation. This is the money that you have to do that, your post-tax income. But if you own a business, this could be a real estate investment business, this could be a business that you created, this could be a business that you bought. Now this is completely flipped. Now the way that it works is you make money from your business, then you pay your expenses right here, and then you pay taxes on whatever is left. Because now these expenses are deductions that you can take against your gross income, which is why you have a much lower tax liability, a lower taxable income, because you're paying for your expenses first. Now the question is, what can these expenses be? Well, these expenses have to be used inside of your business to help grow your business, but this again is where the help of an accountant is going to become so important. That way you can classify the right expenses, that way you can use as many expenses and deductions as possible. I own a business. I need a laptop to run my business, so my laptop was an expense that I get to deduct from my income before paying taxes. I need a phone for my business, so I deducted my iPhone from my income. I had to go to San Diego last year, I had to go to Manhattan last year. I spent about 2 months in San Diego and about a month and a half in Manhattan last year. Both of those were expenses. I got to expense my travel, my flight, my Airbnb, my meals. All these things were expenses that I got to deduct from my income before my taxable income. Now, if I didn't own a business and I wanted to go to Manhattan, well, now I have to spend that money with my post-tax income. I make money, I pay taxes, and then whatever's left I have to use to fly to Manhattan. If I wanted to go to San Diego, the same thing. If I wanted to buy a cell phone, same thing. If I wanted to buy a laptop, same thing. Here, if I needed to buy a truck for my business, if it classifies under the right exemptions, because there are deductions out there right now that will allow you to deduct the value of a heavy vehicle against your income. So if I went out and bought a $150,000 G-Wagon, I could deduct most of the value of the G-Wagon against my income. Now again, I have to justify that I'm using it in my business, but this is where now clever accounting comes into play. Like last year, my accountant kept telling me to buy a G-Wagon. Why a G-Wagon? Because he said that we could justify that if I bought a G-Wagon, he could say to the IRS, look, Jaspreet is an influencer. He needs to maintain his image as an influencer. How can he do that? Well, he can buy a G-Wagon, and now this G-Wagon is a tax deduction for him. Now, did I buy a G-Wagon? No, because for me, I don't want to go out and just spend my money to spend it, not to pay money in taxes. I'd rather pay a little bit of money in taxes and have more money at the end of the year rather than go out and buy something that I don't need. But this is where fancy accounting can come into play if you have a good accountant, because now you can use a tax code which is written by the IRS. And now you can use the code to your advantage, but you have to understand how it works. Now, I am not an expert in the tax code, but I have hired an expert in the tax code. I have hired an accountant whose sole job is to study the tax code, study the deductions, stay up to date on what's happening, and then tell me what I can do in terms of tax planning so I know how to spend my money and different ways for me to now use my money. That way I can pay less money in taxes legally. Remember this, it's not how much money you make that matters, it's how much money you keep. If a doctor, a stock market investor, and a business owner all made $1 million in a year, they're not all going to keep the same amount of money after taxes. The doctor might be paying 40 to 50% of that money in taxes because that's ordinary income and you have the least deductions. Now, the amount of money you're going to actually pay is going to depend on what state that you live in, what state taxes you have, but you might have to pay $400,000 to $500,000 that year in taxes, meaning you're left with $500,000 to $600,000 worth of your income. Still a lot of money, but nowhere near the $1 million that you earned. The stock market investor earned portfolio income, which means you get the benefit of a lower tax rate, which means the top tax rate for you is 20%, meaning you're going to be paying about $200,000 in taxes. You still made $1 million, but you get to keep $800,000 out of that million. And third, now you have the business owner who made $1 million. Now, if the business owner made $1 million but had no other deductions, that was their profit, that's their taxable income, they're going to pay the same tax rate as the doctor, that $400,000 to $500,000 in taxes. However, you have the ability now to harvest debt that the doctor couldn't do. And this means that you'll have the ability to keep money in your bank account and not have to pay taxes on all that money. Now, there are two ways for you to use debt as a business owner to earn money and not pay any money in taxes legally. But I got to give you a little bit of a disclaimer here, because anytime you use debt, you increase the risk. You increase the risk of you failing. You increase the amount of expenses that you have, because no matter what happens, even if your business starts to struggle, you still got to make your debt payments. So anytime you increase the debt, you increase the risk and you increase the chance of failure. So don't do this for the purpose of just saving money in taxes unless you really understand the risk, unless you understand the issues that could happen with debt, and unless you fully understand that, don't use debt. I personally don't do these strategies because for me, I don't want to go out and just take on debt to save money in taxes. If I was to use debt, I want to use it strategically to help grow the business. So just understand that the debt increases risk. Option number one is to follow the Elon method, which is now where you don't take out an income from your business, but rather you use debt to finance your lifestyle. So one of the things that Elon made really popular was the fact that he doesn't earn an income, a salary income from Tesla. He gets paid in stock options. What that means is he owns a lot of Tesla stock, billions and billions of dollars worth of Tesla stock, but this isn't cash in his bank account. So now if he wanted to actually receive any cash, he had two options. He could, one, go out and sell this Tesla stock, but as soon as he sold this Tesla stock, he'd have a huge taxable income because he created Tesla. So his basis in the Tesla stock is very low. So if he sold his Tesla stock for a huge profit, which is what he'd be doing, he'd have a big taxable income. Option number two is he can refinance out of his Tesla stock. He can use debt against the value of his Tesla stock and use his debt to pay for his lifestyle, because debt isn't taxable. It's easier to understand this with bigger numbers, so let me just explain what this means. Let's assume now that you own a business making $1 million a year. If your business is making $1 million a year, it might be worth somewhere between $10 million and $20 million, 10 to 20 times multiple, depending on what industry your business is and what your business does. So your business is worth $10 to $20 million. Now the question is, how can you realize the value of this business and use this value of your business without actually selling your business? Because if you sold your business today for $10 to $20 million, you're going to have a big tax bill. But if you just took out debt against the value of your business, now this debt isn't taxable and you also still own your business. So if you go to the bank and you say, hey bank, I have a business worth $10 million. Would you be willing to loan me $1 million? Most banks, assuming you go to the right one, are going to say yes. So now you go to the bank and you take out a $1 million loan, because the bank wants to give you money because they see the value of your business. And if you don't pay your loan, well, now the bank will get a $10 to $20 million business. So most banks want this deal because if you fail, they're going to win big time. So this is why banks would be willing to loan you $1 million. Now you have $1 million in your pocket, tax free. Because now if you were to go and refinance your home, that debt that you get that isn't taxable, debt isn't taxable. So you're just pulling cash out, tax-free with debt, and now you have $1 million to spend. Now you can use this $1 million to buy a home, you can buy a car, you can buy food, and you can live your life, and you don't have to pay any money in taxes. Now you might be saying, but now how are you going to pay back this debt? Because everybody has to pay back this debt, right? Well, the question now is, what are you going to do with your business? Because if you can keep growing your business, maybe in a few years your business isn't worth 10 to 20 million, it's worth 50 to 60 million. Now what you can do is you can say, hey bank, how about you give me another $5 million now, because my business is worth 5 times more. Now you have more money, you use this more debt to pay back this debt, and you start to play this debt game where you pay back your old debt with new debt. Now if you keep doing this until you die, you win. But the risk here is what happens if your business fails? What happens if your business doesn't grow? What happens now if you run into financial struggles? You can start to see where the risk is, but this is a way now for you to use debt as a way to finance your lifestyle without having to pay any money in taxes, because you're not taking any money out from your business. You're using debt to finance whatever you're doing, using the value of your business as security. The value of your business is the collateral. And you're using that to get a loan, which is why now this loan is tax-free. You use this money to live your life, but you only have to pay taxes if you actually pull money out. If you have taxable income, and debt is not taxable income. The second way to use debt would be to buy bigger deductions. Let me give you an example. So let's assume now that you own a business and this business makes $100,000 of profit this year. This would be your taxable income, assuming that you have no other deductions. But let's assume now that you want to go out and you want to buy that G-Wagon and you want to be able to deduct this G-Wagon against your income. Well, if a G-Wagon costs, let's just say $100,000, well, that means you're going to be out all of your cash if you buy the G-Wagon with cash. Well, option number two is you put down $20,000 and now you finance the other $80,000. If you were to finance the other $80,000, now you only put down 20 grand, which means you still have 80 grand in your bank account. And now you have a G-Wagon, but now you also get the tax write-off for the entire G-Wagon. Now let's assume that you use 80% of the G-Wagon for your business and you use 20% of the G-Wagon for your personal life. Meaning sometimes you take this G-Wagon and you go to the movies, you hang out with your friends, you do other things. So the G-Wagon is primarily business use and some of it is for your personal life. Now, what you get is an 80% deduction on the value of the G-Wagon against your taxable income. 80% of the $100,000 G-Wagon is an $80,000 deduction against your taxable income. So now you get an $80,000 deduction against your $100,000 income, meaning you only have $20,000 worth of taxable income, but you have $80,000 in your bank account. Remember, you didn't buy this G-Wagon with the $100,000 in your bank account. You bought this with a loan. You used debt. So you put down $20,000, which is why you have 80 grand in your bank account. You use the other $80,000 from the bank's money to buy the G-Wagon, but you still get to deduct 80% of the value of the G-Wagon, or $80,000, against your income. But this is where things really get fun, because now what happens if you buy something for your business, but you don't have enough income to support the value of your deduction? Let me show you what I mean. By the way, if you are an entrepreneur and you want to stay up to date on the latest business trends, you want to know what's happening with the latest innovation trends, that's why I created Business Briefs. That's a completely free resource for entrepreneurs to keep you up to date on what's happening in the business and entrepreneurship world. You can read it in less than 5 minutes every morning, and every day my team is covering the latest innovation trends, the latest business trends, and the latest in funding trends. You can read it for free, and I'll put the link to how you can join Business Briefs for free down in the description below. So let's assume that you want to buy a G-Wagon, but you don't make $100,000 a year. You only made $25,000 a year. Now, I'm not going to recommend anybody do this. I'm just talking about how the taxes work, and I'm talking about how debt works when it comes to taxes. Okay, so take this for what it's worth. You made $25,000 this year in your business. Nice. Now you want to go out and ball out with a G-Wagon, but you don't have $100,000 to buy this G-Wagon with cash. So what do? You put down $20,000 to buy this $100,000 G-Wagon, and you finance the other $80,000. Now, you will get that same $80,000 deduction. But how are you going to write off $80,000 of a deduction when you only have $25,000 worth of income? Because now you subtract this $25,000 that you could, now you have $0 of taxable income, but you still have a lot of money left over in this deduction. Well, now you have a loss, because now you get to tell the IRS, okay, I didn't actually have any taxable income. In fact, I had a $55,000 loss in my business because, well, I had to go out and buy this G-Wagon. Now again, this doesn't mean that you have negative $55,000 in your bank account. You still have 5 grand in your bank account because you financed this G-Wagon. So you have $5,000 in your bank account right now. You tell the IRS that you have a $55,000 loss because you get to deduct 80% of the value of this G-Wagon. Now, next year, you might make a little bit more money. Let's assume next year that you made $35,000 in your business. Nice. Well, now you tell the IRS, hey IRS, I made $35,000 in my business this year. But last year, I lost $55,000. So now you deduct this against this, and again, you have $0 of taxable income. Because now you had $35,000 of profit, which is in your bank account. This plus this means you have $40,000 in your bank account. But again, $0 worth of taxable income because you get to carry forward this loss. Then the year after that, you get to take the leftover from this loss on your income again. Now you can start to see how some business owners will be able to use debt strategically to carry forward losses against their income. And this can get much bigger when the dollars are bigger too. It doesn't have to be cars, it doesn't have to be planes. You can buy machinery, you can buy other equipment for your business. You could potentially buy real estate strategically. There's other rules with real estate which will now allow you to deduct the value of the asset that you bought from your income. Show a loss on taxes even though you have cash in your bank account, even though you're making a profit on paper. You have cash, you're making a profit, but you have a taxable loss. And now you can take this taxable loss and move it forward every single year, as long as the IRS said so, but you can keep moving forward this loss, which means you make a profit, you have more cash in your bank account, but you owe no money in taxes legally. Let me give you another fun example. Let's assume that you made $2 million this year from your business. This is the profit, this is the cash in your bank account. Now, if you just left this money as it is, you don't have any other deductions, you're gonna have a pretty big tax bill, because if you have $2 million of income, that's a big tax bill. But now, if you were to go out and buy, let's just say, a $20 million plane, well, now, what are you going to do? Well, you're going to put down $2 million to buy this $20 million plane, and you're going to finance the other $18 million. So this is $18 million worth of debt. And now the IRS has some special tax provisions on planes, which will allow you to deduct pretty much the entire plane this year. Which means now you get to tell the IRS, hey, I made $2 million minus these deductions, which is this $20 million plane that I just bought, even though you only put down $2 million. So that means you have negative $18 million in taxable income. Now next year, if you made $4 million, you just carry forward this loss. And the year after that, you can carry forward the loss again. And you do that again and again and again. And then maybe you could sell this plane for $20 million. Maybe you sell it for a profit. Maybe you sell it for a little bit of a loss, but you're making money every year and you're paying little to no money in taxes. And this is completely legal. Again, this is why it pays to have a good accountant. Now, this doesn't mean you have to go out and buy a plane. This doesn't mean you have to go out and buy a G-Wagon. There's so many other ways to do this. Just planes and G-Wagons are fun to talk about, but there's so many other ways to do this, which is why you want to make sure you have a good accountant on your side. That way you understand the different deductions that are possible. That way you can actually use them. This is what strategic tax planning is, because tax planning is all about understanding the different ways that you can spend money. That way you can have cash in your bank account and pay little to no money in taxes legally. Now, of course, when it comes to debt, you have to understand debt comes with its own risks. Our economy goes through highs and lows, meaning you have to predict that there are going to be times where your business will also go through highs and lows. And so if you use debt, you have expenses that never go away. And so you have to factor that in there. So don't just go out and take on a whole bunch of debt because, well, you don't want to pay any money in taxes. Understand the risks with that, because debt has its own risks. This is where you want to be financially smart, but then you also want to be tax smart. That way you can pay the least amount of money in taxes legally. A hard asset is a real physical asset, as opposed to saving your money cash, because cash is just pieces of paper, and potentially saving your money in the stock market, because the stock market is also liquid and a paper asset, which means that you really don't own anything physical, anything tangible. When you own real estate, the actual property, not only do you own the land,